Welcome to Conversations, a weekly audiocast featuring interviews with leading investment strategists and recognized financial professionals. Brought to you by the Market Technicians Association.
This is Conversations, the official MTA podcast series, and today's guest is Dennis Gartman. According to Gartman, it only takes 24 hours to go from genius to idiot. Mr. Gartman has been directly involved in the capital markets since 1974 after his graduate work at the North Carolina State University. He was an economist for Cotton Incorporated in the early 1970s, analyzing cotton supply and demand in the U.S. textile industry. From there, he went to the NCNB National Bank in Charlotte, North Carolina, where he traded foreign exchange and money market instruments. In the late 1970s, Mr. Gartman became the chief financial futures analyst for A.G. Becker & Company in Chicago, Illinois. Mr. Gartman was an independent member for the Chicago Board of Trade until 1994, trading in Treasury bond, Treasury note, and Ginnie Mae futures contracts. In 1984, Mr. Gartman moved to Virginia to run the futures brokerage operation for the Sovereign Bank. And in 1987, Mr. Gartman began producing the Gartmin Letter on a full-time basis. He continues to do so today. Mr. Gartman appears often on CNBC, Rob TV, and Bloomberg Television, discussing commodities and the capital markets, and speaks before various association and trade groups around the world. Welcome to the program, Dennis.
Nice to be here, Lance. Thanks for having me on. That introduction, you must have been talking about somebody who was smart. You clearly were not talking about me.
Oh, no, it's our pleasure to have you this morning. Let's go back to the beginning. Tell me about your background. What initially attracted you to the financial markets?
You know, actually, it goes back to growing up in Ohio. I was a caddy at a country club. That's something that a lot of kids did back in the 1960s. And I noticed that the fellows who were playing golf at the country club tended to be stockbrokers and bankers. My father, having been a machinist, wasn't a member of a country club, and I thought it's abundantly clear that they've got a better life than my father did or than I did, and it seemed to me the only major difference was go to university. So I made sure that I went to college. I was a diver, got lucky to have a scholarship, and also had a caddy scholarship, went to university, loved learning, got my graduate degree at NC State, and then loved the markets. My first job was as the chief economist for Cotton Incorporated. Wrote a couple articles on how this new thing, the financial instrument futures, which were coming due, we're going to begin trading, would change how markets traded, would change how people reacted to markets. Went to work for NCNB, traded foreign exchange, which was wonderfully good fun, and conned the bank, Harris Bank, to lend me enough money to buy a seat on the Chicago Board of Trade. Traded there for about 9 years, loved that, learned a lot about psychology on the trading floor. I learned that the least intelligent people in the markets are usually floor traders, and I'm always still amused at how people want to know what does the floor think, and as an ex-floor trader I can tell you, you really shouldn't care. All the floor thinks about is it a big 5 bid, and how small is the 6 offer? That's all they know about. So I had a great career. I've been writing the newsletter now and trading for my own account for the last 25 years, and I guess I'm proudest of the fact that I haven't missed a day in 25 years of putting this newsletter out. Every morning I get up at 1 o'clock Eastern time to try to produce 7 or 8 or 9 pages of hopefully cogent, hopefully insightful, every once in a while comical commentary on what's going on in the global capital markets. I've had a great life. I'm one of the luckiest people I know.
How would you categorize yourself as an analyst and a trader? Are you top down? Are you bottom up? Are you fundamental? Are you technical?
Yes,
something else?
yes, and yes. I'm willing to steal from all different schools. I'm willing to steal from the fundamentalists. I'm willing to steal from the technicians. I'm willing to steal from psychology. I'm willing to do a lot of things because the markets move in a great number of fashions. I always consider myself to be the liberal arts major of the capital markets. I know a reasonable amount about the oil market. I know a reasonable amount about the grain and cotton markets. I know a reasonable amount about the bond market. I know a reasonable amount about equities. But what I did find over my career is that the equities traders don't talk to the bond traders, who don't talk to the oil traders, who don't talk to the foreign currency traders, who don't talk to the commodity traders. And my job was to try to find what it is within those markets that correlate. What are the motivations in one market that an oil trader might not know is happening over in foreign exchange? So I like to say that I'm the liberal arts major of the capital markets, and I think I've carved out that niche over the course of the last quarter century. Let's hope I can continue for another quarter century.
Can we have a peek into your technical toolbox? What are some of your favorite technical tools, and how did you become fluent in those?
First of all, I'll tell you that I am the simplest technician the world has ever seen, and I've learned to become simple because the fellows who became the most complicated, I found very rarely succeeded. Simple works. The smartest people I know, the Paul Joneses, the Louis Bacons, keep their technical circumstances very simple. They draw trend lines. They use broad moving averages. They know that bull markets make higher highs and higher lows. They know that bear markets make lower lows and lower highs. Those are the simple things, and they work the very best. So I'm a very simple technician. I want to make sure if I'm bullish on something from a fundamental perspective that, in fact, it is going up, that it is moving from the lower left to the upper right. I want to make sure that if I'm bearish on something for fundamental reasons, that it is going down, that it is moving from the upper left to the lower right, that each low is lower, that each high is lower. I really don't want to get, nor do I ever get, any more complicated than that, because I think complication breeds confusion, and confusion breeds non-success. So I'm a very, very simple technician. Go out and take the simplest technical books that you can. Edwards and McGee, I think, written back in the 1930s. Technical analysis of stock market trends is probably as good a guide now as it was then.
Mm-hmm. Do you use anything in the way of timing tools?
I'm not sure what is meant by the term timing tools, but I guess the answer is no. I mean, all markets, all movements that you make, all decisions that you make are timing. Every once in a while I'll draw on the chart what I call the box, which is where markets should retrace to 50 or 62% of their previous rally to the upside, or retrace the 50 to 62% of the recent break. And I guess I'll draw that box and say in some matter of time we should move into that area. But do I try to time things? Not, I guess, in the most sophisticated terms. Again, I try to keep this fairly simple. And you know what? It's worked.
Mm-hmm. Now, you have a long history with foreign exchange. Is there an advantage to viewing the world through this lens?
Well, I think that all things driven in the world are driven first by demographics and secondly by currency considerations. I just think that's abundantly clear. I think that there are times when a weak dollar, if you think that the dollar is going to be and is consistently weak, that's probably going to give rise to stronger commodity prices. If you're in a period of time where you expect the dollar to be and it is indeed stronger, that will give way to weaker commodity prices. But after that, watching the foreign exchange market and trying to make predictions as to where equities prices are going to go, you can find yourself in a bit of a quandary, because I'm amused at the number of people who think that you can't have a bull market in U.S. equities without having a strong dollar is just wrong. The greatest bull markets in equities actually occur during periods of declining currency valuation. And it's always good to know, and this is always a good piece of information to keep filed in the back of one's mind. The strongest stock market in the world in the last 20 years was the stock market in Zimbabwe, which went up, a trillion%, but because the Zimbabwe dollar fell by about that same percentage. Stocks went up dramatically, even as the currency was plunging to its death. Weak currencies tend, and the operative word here is tend, put it into quotation marks, weak currencies tend to beget stronger stock markets in that nation. Strong currencies tend, and put that again in quotations, to give way to weaker stock prices. You can't say the same thing, however, when it comes to the bond market. So I think that it's helpful. I think it's beneficial. I think it makes you more sophisticated. I think it gives you a better view. If you watch what the foreign exchange market is doing, it can give you some leads into where markets are going, and especially in the commodities markets.
Now, a lot of your trade recommendations seem to go in pairs along with a currency. Is that why?
Well, I was trained as a spread trader. I was trained, and I think in terms of being long of this, short of that. I think in terms of being long of nat gas, short of crude oil. I think in terms of being long of gold, short of the yen. I think in terms of being long of gold, short of grains. I just was trained on the exchange floor to be a spreader, and that has carried over into my thinking. I think on balance it is easier to understand relative value than it is to understand flat price. So I think in terms of buying wheat or selling corn, or buying corn and selling soybeans, or buying soybeans and selling meal. I just think in those terms, and I think it has served its purpose well.
Okay. So as if the markets weren't hard enough already, you publish your market views. And recently you were quoted as saying, this is without question one of the most poorly timed trades of your career. And I think that was in regards to a yen trade. And you've been in the markets for over 40 years, so that's quite a statement. So can you comment on, was this a isolated trade? Is this more the market in general right now? And how do you bounce back after a round, if you will, with the market like this?
Well, first of all, it was a horrific trade. It was about 2 weeks ago. It was when the Bank of Japan had announced a very aggressive easing policy. The Japanese yen had been weakening. I had been short of the yen, and on that move, I got shorter of the yen. I think that's a reasonable response to a statement from a central bank that it is going to ease monetary policy aggressively. What was amazing was how swiftly that currency turned against me. It was only an hour later that in the yen, a 30-pip move is a fairly sizable move. A 50-pip move is very sizable, and one big figure, a whole yen move, is extraordinary. We moved about 1.5 yen in the course of an hour. It was really amazing to me and embarrassing because you don't get things that wrong. It's not the first time I've gotten something that wrong, and it certainly will not be the last time I get something that wrong. The important thing is I got out, and what is really important is once you're out, the mind clarifies. Once you're out, you can see things far more clearly. Once you're out, and you need the ability in this business to forget your losses. You just need to forget them. You just need to get rid of them. They're done. They're over. And that's probably the hardest thing. One is always reluctant about jumping back, or jumping back into the swimming pool and going into the deep water, but you have no choice. It was a silly trade. It was a bad trade. It went violently against me, and I got out. As we speak, I'm right back in selling yen because it has not made any new highs. I'm selling yen again, but I'm at the same time buying gold. So that's working. The market's telling me I'm correct. The gold side is what's proving to be the best. The yen side is proving to be of absolutely no value whatsoever, other than, as I said earlier, I tend to be a buyer of this and a seller of that, and I always feel better if I have a long position on to have something short against it. So I'm long gold as we speak, and I'm short the yen, and it seems to be working. The market's telling me I'm right. We'll see what happens. Okay.
What's one of your more memorable, favorable trades or market calls you've had over your 40 years?
Oh, I guess being consistently bullish in the last several years of gold, I've told people, and first of all, I'm not a gold bug. I don't like the gold bugs. And every time I'm asked the question, I begin the conversation with gold by saying I don't believe in the manipulation theory. I don't think we're all going to hell in a handbasket. I don't think the authorities are out there trying to devalue currency on a regular basis. I'm not a gold bug. I'm actually an optimist. But the gold market, if the monetary authorities are doing what they are doing and what they're telling us they're doing, which is that they are expanding the supply of reserves at an aggressive pace, it's illogical not to be bullish of gold. It's just another currency. I view gold the same way I view dollars, the same way I view euros, the same way I view yen, the same way I view the Canadian or the Aussie or the New Zealand dollar or the Indian rupee. It's just another currency. And so in that instance, I've been bullish of gold, continue to be, and I think that that's been the proper trade. I think it's been a very wise position. I think it's been one of my more memorable. And what's interesting is how often I get attacked by the gold bugs for not being bullish enough, and how often I get attacked by the gold bears for not turning bearish. So it's been working. It's moving from the lower left to the upper right. It's been doing so in non-U.S. dollar terms. And I actually think one of my more memorable trades was one just done 2 weeks ago, where I bought gold in, this will sound odd, in grain terms. I thought gold was cheap relative to corn. I thought gold was cheap relative to soybeans. And so I've been buying gold and selling grains against them. That, to me, that's buying gold in grain terms. And gold is up $40, and the corn market's down 50 cents, and beans are down 80 cents, and soy meal's down $70. So it's been a good trade, and actually I'm doing more today.
Any current market views that you can share with us?
I think we're in a risk-on environment. I think the monetary authorities, whether it's the Fed or the Bank of England or the Bank of Japan or the ECB or the Bank of Canada or the Bank of the Reserve Bank of Australia, are all erring upon the side of easier monetary policies. They're all erring upon the side of wishing to push equities prices higher. And whether you agree with what they're doing or not, whether you like what the Fed is doing or not, that's not my job. My job is not to cast stones. My job is to simply say, this is what they're doing, and what effect does that have upon markets? I'm agnostic, and I can cast my lot with either side. Right now, it's abundantly clear that the monetary authorities are erring upon the side of easier monetary policies. They want to push stock prices higher. Don't fade them. Don't fade the Fed. Don't fade the Bank of England. Don't fade the Bank of Canada. Don't fade the Bank of Japan. Don't fade the ECB. Join them. They have bigger checking accounts than you do. So I think it's a risk-on environment. I think they want to send stock prices higher, and in that instance, you want to be long on the stock market. If you feel the need to hedge them out in some way, buy puts. If you feel the need to hedge them out some way, you might consider selling bonds. That's I think where we're at right now. It is a risk-on environment, and to tout something that we've come up with my friend Mark Fisher and I actually have an ETF listed on the New York Stock Exchange. I love the ticker symbol ONN. It is, if you think that it is a risk-on environment, go buy ONN, because in ONN you get to own U.S. stocks, British stocks, European stocks, copper. You get to own crude oil. You get to be long of the euro. You're short of the bond market. You get them all in one nice little tidy package. It's ONN. That's risk on. If you think we're in a risk off environment, interestingly enough, we have OFF, and you got to admit those are good ticker symbols. Even I can remember them.
Great
OFF
ticker
is
symbols.
good ticker symbols. OFF is the mirror image. But right now, I think it's a risk on environment, so I think you want to buy risk on.
Is there anything you'd like to add before we go, including how could somebody find your Gartman letter?
Two things I'd like to add. The most important thing in the business of investing is to admit when you're wrong. That's the most important thing you can do, is to admit when you're wrong. And we're going to be wrong a lot. The trick in the business is not to be wrong and to stay wrong. That's the worst. That's the second worst trick. The worst trick is to be wrong and do more of that which is wrong. I try to live by the simple statement, let's do more of that which is working, and let's try our best to do less of that which is not. And I think that's a good notion in life. It's a great notion in trading. Do more of the things that have been working for you. Do less of the things that have not been working. And where can people get hold of me? They can, if they'd like to take a look at the newsletter, we're happy to send it to them for a while. It's not inexpensive, and my wife doesn't like me to say that, but I think it's the right thing to say. It is expensive because it is done every single day, and I haven't missed in 25 years, and it's there at 5:15 every morning. You can write into the Gartman Letter. We have a website, thegartmanletter.com, and Chip or Liz will get your name and from the login, and they'll send you copies of the newsletter for a month. Take a look at it, and if you don't like it, that's your problem. Won't be mine.
Dennis, thank you for your time this morning. I appreciate it very much.
Oh, thanks for having me on. Thanks for the questions, and I was honored to be asked. So as I end every newsletter, good luck and good trading.
Today's guest has been Dennis Gartman, and that concludes today's MTA podcast from LexingtonCapitalLLC.com. I'm Lance McDonald, together with recording engineer Shane Skwarek at the MTA, reminding you that price is always right.